Good afternoon, everyone. Today we're diving into one of the most fascinating and structurally underappreciated stories in public markets, a rare convergence of accounting reform, monetary evolution, and index mechanics. At the center of it, a company once known for enterprise analytics software. Now better known for hoarding more Bitcoin than El Salvador, Tesla, and Coinbase combined, Strategy, formerly MicroStrategy. It turns out that when you stack over 500,000 Bitcoin and embrace fair value accounting, things start to get interesting. This presentation will focus on Strategy's highly probable inclusion in the S&P 500 following Q2 2025. We're going to explore the specific requirements, especially the notorious GAAP profitability test, the impact of the new FASB accounting guidance that finally allows digital asset fair value recognition, and the tidal wave of passive inflows that would follow S&P inclusion. And we're not talking theory. I'm going to show you detailed financial pathways, historical analogs like Tesla, Coinbase, and even a Monte Carlo simulation modeling MSTR's price action under various Bitcoin and inclusion scenarios. Spoiler alert, the distribution is wide, the upside is violent, and the downside, well, let's just say it, it mostly exists if Bitcoin goes back to $30,000 and Michael Saylor decides to become a monk in the Andes. So buckle up. This is about how a balance sheet strategy originally dismissed as lunacy is now knocking on the door of America's most prestigious equity benchmark. And when that door opens, every 401k, every index ETF, every pension fund that tracks the S&P 500 is going to become a low-key Bitcoin hodler, whether they like it or not. Let's begin with a high-level overview of how we got here and why this moment matters. First, we have to acknowledge that Strategy is now less of an operating company and more of a public Bitcoin acquisition entity. Since August 2020, the firm has turned its cash flows, credit lines, and shareholder equity into ammo for stacking Satoshis. Their Bitcoin holdings have absolutely exploded, crossing over 568,000 Bitcoin by mid-2025. That's not a typo, folks. That's nearly 2.7% of the total circulating supply. It's as if Berkshire Hathaway decided its core products were gold bricks and laser eyes. This Bitcoin-heavy balance sheet means Strategy's financial performance has become highly correlated to the price of Bitcoin itself. In bull markets, its valuation grows reflexively with every uptick in Bitcoin. And in bear markets, well, you just don't check your portfolio that month. When Bitcoin crossed 80,000 and touched six figures, Strategy's market cap ballooned, well above the 20 to 21 billion threshold required for S&P 500 inclusion. The company now checks all the easy boxes. It's US-based, it trades on the NASDAQ, it has ample liquidity, and a sufficient public float, even if a good chunk of that float is in the hands of short sellers who are quietly sweating blood. But the real inflection point is this. Inclusion in the S&P 500 would trigger mechanical forced buying from trillions in assets benchmarked to the index. This is not speculative demand. It's not about sentiment, it's about compliance. Index funds don't get to have an opinion when the committee says MSTR goes in. They hit buy. And when they hit buy, they don't trickle in value investors sipping tea. They come in like a SWAT team on a Red Bull drip. And more importantly, passive inclusion means that Bitcoin, via Strategy's balance sheet, gets stealth exposure to millions of investors who may have never intended to hold crypto. That's an inevitability if MSTR enters the S&P 500. We're looking at the slow motion institutionalization of Bitcoin through the most conservative, rules-based vehicle in capital markets, the index itself. And somehow Michael Saylor pulled this off while quoting Plato and tweeting like a Byzantine priest. Let's now turn to the formal gatekeeping apparatus, the eligibility criteria for the S&P 500 inclusion. There are 5 primary requirements. Number 1, market capitalization, currently set around 20 to 21 billion for 2025, adjusted periodically to reflect market inflation. Number 2, US listing and incorporation. The company must be domiciled in the United States and listed on either the NASDAQ or the New York Stock Exchange. Number 3, sufficient public float, at least 50% of the shares must be available to public investors. Number 4, adequate liquidity measured by trading volume, frequency, and depth. And number 5, GAAP profitability, and this is the sticky one. On market cap, Strategy clears it with room to spare. Depending on Bitcoin's spot price, Strategy's valuation ranges from, $80 billion to $110 billion right now. At a 6-figure Bitcoin price, it punches well above the cutoff. This box is already checked. Listing and liquidity, also covered. Strategy is a NASDAQ-listed US firm with deep and consistent trading volume, often outpacing many tech names that are already in the index. The public float, while reduced to insider holdings and institutional positions, still meets the threshold. Now, profitability, this is the Achilles heel that kept Strategy out until now. S&P rules require positive GAAP net income in the most recent quarter and positive cumulative GAAP earnings over the trailing 12 months. Historically, Strategy failed this test not because its business was fundamentally unprofitable, but because of antiquated accounting treatments for digital assets. The firm could book massive real-world gains in Bitcoin holdings, but if there had ever been a dip in price just once, GAAP required them to write it down. And when Bitcoin rose again, those gains stayed invisible, like a tax bill from 2040. Unrealized but inevitable. So you'd have quarters where Bitcoin doubled and Strategy was reporting billion-dollar losses. It was like winning the lottery and somehow owing child support for someone else's kids. That's why for years, despite size and liquidity, Strategy remained outside the S&P 500, not because it didn't belong structurally, but because the reporting framework treated volatility as a sin. But in 2025, everything changed. Enter the Financial Accounting Standards Board, FASB. FASB issued a deceptively boring label for one of the most transformative developments in crypto financial history. Under the old rules, Bitcoin was treated as an indefinite-lived intangible asset. That's the same category as brand goodwill or a really good reputation, which ironically, neither accountants nor crypto companies ever actually have. What this meant in practice was brutal. If Bitcoin's price ever dipped, even intraday, the firm had to impair that portion of the assets permanently. But if Bitcoin rebounded, no write-up allowed. The recovery wasn't reflected in the earnings. This created comically distorted financials. For example, in Q4 2024, Strategy took a $1 billion impairment charge, even though Bitcoin ended the year at nearly $94,000. Why? Because it previously had dipped under $16,000, and under GAAP, they were stuck valuing at its lowest tick since acquisition. Think about that. You could be owing a warehouse full of gold bars, but if someone once saw a fake one on eBay, you had to price the whole inventory at scrap value. Now, under the new rule, effective Q1 2025, Bitcoin is marked to fair value every quarter. Price gains and losses flow through like net income, like any normal asset class. The implications are profound. Bitcoin now enhances GAAP earnings when it appreciates. It no longer penalizes the income statement permanently for momentary dips. And for Strategy, this finally unlocks the ability to show true economic performance of its treasury. Here's the scale of change. By April 2025, Strategy held over 528,000 Bitcoin at an average cost of $67,500. With Bitcoin trading between 85,000 and 100,000 during Q1 and Q2, the company had over $10.7 billion in unrealized gains. Gains that now hit the income statement thanks to FASB's guidance. In other words, the moment Bitcoin stopped being an accounting liability and started becoming an earnings amplifier, the S&P profitability barrier began to crumble. You could call it a regulatory green light, or if you prefer the biblical framing that Saylor tends to favor, this was the moment the stone rolled away. Now let's walk through the timeline that leads to the inflection point, the moment Strategy clears the last obstacle and becomes eligible for S&P 500 inclusion. We'll begin in Q4 2024. Bitcoin had rallied strong by year end, closing near $94,000, but thanks to the old impairment model, Strategy still reported a GAAP net loss of $671 million, anchored by valuation hangovers from 2022 and 2023 when Bitcoin bottomed in the teens. This created a paradox. The company's treasury was richer than ever, but its income statement looked like it had been hit by a freight train full of auditors. Then comes Q1 2025. Strategy early adopts the FASB fair value accounting rules, finally allowing them to recognize BTC appreciation in earnings. But fate had one last joke. Right before quarter ends, Bitcoin dipped sharply after they had made aggressive new purchases near the local top. And that led to a $5.91 billion unrealized loss under the new accounting regime, ironically using the very rule that was meant to fix this problem. That loss kept the trailing 12-month net income negative, pushing back the S&P clock. But Q2 2025 is different. This quarter, Strategy enters with a massive Bitcoin inventory and a cost basis of $67,500. As of May, Bitcoin is consistently trading in the $95,000 to $100,000 range. If it holds, that creates multi-billion-dollar fair value gains for the quarter. Not just good optics, those are hard GAAP earnings, and they don't just look nice in a press release. They mathematically wipe out the prior impairments and losses from Q4 and Q1. So what does that mean? If Strategy closes closes Q2 with Bitcoin above $95,000, the company will likely show positive net income over the trailing 12 months for the first time since it began stacking Bitcoin at scale. And that's the key. It's no longer about aspiration. It's not about sentiment. It's about arithmetic. If Bitcoin holds the line through June, Strategy's S&P 500 inclusion becomes not a matter of if, but when. This is the first time the company's Bitcoin strategy satisfies both accounting logic and index eligibility in tandem. Before, the market cap was high, but earnings were underwater. Now, for the first time, both vectors align. You could say Bitcoin is finally getting its revenge on generally accepted accounting principles. So let's talk timing. The question on everyone's mind: when could Strategy actually be added to the S&P 500? Let's anchor this to the known mechanics of the index. First, if Q2 2025 show the positive trailing 12-month GAAP net income, the company officially meets all the inclusion requirements. Those earnings will be filed in summer 2025, typically late July or early August, depending on reporting cadence. From there, the next opportunity for inclusion is the Q3 2025 Index Committee review, which aligns with the September rebalance window. That's the first realistic shot. Alternatively, if the committee wants more time or chooses to queue MSTR behind other eligible firms, year-end inclusion is the backup scenario, typically in December. It's important to note that S&P 500 additions are usually tied to either the scheduled quarter rebalancing or an unscheduled replacement of an existing constituent. Tesla, for example, achieved trailing profitability by Q2 2020, but wasn't added until December 2020. Coinbase more recently was added in May 2025, almost immediately after qualifying to replace an outgoing firm. Now, this is crucial. Strategy already joined the NASDAQ 100. So this isn't their first time at the index rodeo. They've proven float depth, liquidity, and institutional eligibility. What's different about the S&P 500 is its symbolic and structural weight. It's the benchmark for over $5 trillion in passive funds. It's the de facto endorsement of financial legitimacy in the eyes of institutional allocators. And it is the final step in transforming Strategy from a speculative Bitcoin proxy to a structural core holding in the average retirement portfolio. Once the committee has the financials in hand, there's very little to debate. As some analysts have put it, MSTR's adoption of FASB guidance strengthens its case for S&P 500 inclusion. Exclusion would be surprising. So barring a late quarter collapse in Bitcoin, we are now in the countdown window. Any week from late Q3 onward could trigger the announcement, which means indexers, fund managers, and frankly short sellers should probably start preparing now. Here's the single most important dynamic. S&P 500 inclusion triggers forced buying from passive funds. We're talking about a non-discretionary, mechanical, and price-insensitive wall of capital. Roughly $5 to $7 trillion in assets are benchmarked to the S&P 500 via index funds, mutual funds, insurance mandates, pensions, 401ks, all of them. If MSTR is added at even a 0.1% weight, that alone implies $5 billion in mandatory share purchases from passive vehicles. If it lands at 0.15%, the number jumps closer to $7.5 billion. If float adjusted weights place it at 0.1% of the index, that means every index tracking fund must allocate 0.1% of its portfolio to MSTR, regardless of the valuation, narrative, or price action. This is what we call the passive bid, and it's both relentless and inelastic. Now, a bit of humor here. This might be the only time in your investment career when you know exactly what BlackRock is going to do, when they're going to do it, and how many billions they're going to spend doing it. Imagine if every fund on earth was legally obligated to FOMO in all at the same time. That's not a trade, that's a liquidity event. It's also worth noting that front-running this passive flow is a well-established strategy among hedge funds. Traders know the inclusion is coming. They buy ahead of it, and the index funds are stuck buying from them at higher prices. So in reality, this $5 to $7 billion figure may understate the true upward pressure because active funds pile in before the passive funds even lift a finger. This is index mechanics, and Strategy is sitting in the middle of that pressure cooker with a float that's shockingly tight and a short interest that's historically high. We'll get to that in a moment. Now let's zoom out and look at precedents because we've seen this movie before. Let's begin with Tesla. Remember, in 2020, Tesla was added to the S&P 500 in December of that year with an unprecedented 1.6% weight. That means indexers had to buy around $85 billion in Tesla shares in a very tight window. What happened? The stock surged over 60% from announcement to inclusion. On the inclusion day alone, Tesla was up 6% on record volume. That was forced buying. Market impact from passive indexation is real and often violent. Next up, Coinbase, added in May 2025, at around 0.2% weight. That triggered $10 billion in passive inflows, and the stock jumped 24% in one day. Now, let's be clear, Coinbase holds far less Bitcoin than Strategy. In fact, Coinbase doesn't hold BTC as a treasury asset, it's a custodian and exchange. Strategy, by contrast, is Bitcoin with a ticker symbol, so if Coinbase's inclusion triggered a 24% pop, what happens when the Bitcoin balance sheet itself enters the index? And finally, a nod to NVIDIA. While it wasn't a new inclusion, it offers a powerful example of what happens when you're in. As NVIDIA's AI story exploded, its weight in the index grew, and passive funds had no choice. They had to keep buying to maintain their proportional exposure. That's the feedback loop we're stepping into with Strategy. The more Bitcoin it accumulates, the higher its market cap grows, the more weight it takes in the index, and the more money passive funds must deploy into it. It's reflexivity on autopilot, but to put it in plain terms, the inclusion of MSTR could mark the first time Bitcoin exposure is mandatorily embedded into trillions of dollars in retirement portfolios, and no one even asked permission. That's financial colonization. Once it happens, it can't be undone without a full reversal of Bitcoin's price momentum, Strategy's treasury policy, or a structural overhaul of index methodology. Now let's quantify the impact of forced buying using hard data from prior S&P 500 inclusions and project what that might look like for a Strategy. Here's the comparison table. Tesla entered in December 2020 at a 1.5% index weight. This forced about 85 billion in passive buys. Now remember, like I said, if included at 0.1 to 0.15%, the required buying is estimated at $5 to $7 billion. But unlike Coinbase or Tesla, Strategy is one of the tightest floats in the index. Insiders, especially Michael Saylor, control a significant share. The actual tradable float is far below the total shares outstanding. And here's where things get volatile. Over 12% of that float is shorted. As of April 2025, more than 29 million shares were sold short, and over 600,000 shares failed to settle. That's a $180 million notational value failure. That's a liquidity red alert. So imagine this scenario. Index funds are forced to buy billions in a matter of days. Traders are front running that demand, and short sellers are desperately trying to cover before they get steamrolled. You don't need a PhD in finance to see the outcome. You need a fire extinguisher. This is a reflexive short squeeze setup, but with institutional capital as the trigger, not retail euphoria. This is what makes this so dangerous to underestimate. This isn't GameStop with memes. This is a fundamentally qualifying company with real institutional access getting fire hosed with passive money while 12% of its float is hanging off a cliff. Finally, let's acknowledge the meta layer here. Inclusion is a signal. It tells the market that Bitcoin has crossed from a fringe asset to a structural pillar. It tells allocators that Bitcoin's volatility now belongs inside the index, not outside the risk box. And it tells every CEO watching from the sidelines, if a Bitcoin-heavy treasury can get into the S&P 500, maybe it's time to revisit your own capital strategy. Because let's be honest, once MSTR is in the S&P 500, pretending Bitcoin isn't part of the system becomes a form of willful blindness. Now, I've examined Strategy's fundamentals, its qualification pathway, and the mechanical inflows that follow inclusion. Now let's ask the bigger question, what could the stock actually do over the next year? To answer that, I modeled Strategy's price path using a one-year Monte Carlo simulation, a probabilistic framework that runs 1,000 unique scenarios, each simulating 252 trading days with key variables. Number 1, Bitcoin price volatility. Number 2, MSTR's BTC beta. Number 3, the inclusion event. In qualifying scenarios, I modeled a 15% instantaneous price jump mid-2025, reflecting the index bid and short squeeze dynamics we just covered. Let me walk this through what this tells us. The middle 90% of outcomes, that's everything between the 5th and 95th percentile, range from $110 to $1,250 per share by mid-2026. That is more than a 10x spread, which tells us something crucial. MSTR is a convex exposure vehicle, part Bitcoin proxy, part inclusion catalyst, part float-locked volatility amplifier. Now let's break this down further. The median price path settles around $375 to $400 a year from now. The mean is higher, around $480 due to a fat right tail. That's classic and asymmetric bets. The extreme upside pulls the average up. In roughly 5% of simulations, MSTR ends above $1,250. In 1%, it ends above $1,900. These are your mania paths. Bitcoin hits $150,000. Inclusion triggers a squeeze, and MSTR enters an overbought but very real parabolic reflex loop. But we also have downside scenarios. In the bottom 5%, MSTR falls to the low 100s, driven by a major Bitcoin drawdown, say to $30,000 or lower, and no S&P 500 inclusion. This tail is real. We all know Bitcoin volatility cuts both ways. And remember, strategy amplifies that volatility through its capital structure. So what's the takeaway? You're not buying MSTR for stability. We all know that. You're buying it because it's a structured bet on Bitcoin monetization, leveraged by index mechanics and reflexive flows. That's the design, folks. That's the design. Let's summarize key insights from the simulation. The first thing that jumps off the chart is the sheer breadth of outcomes. Strategy's path is extremely wide, not because its business is chaotic, but because it's a value driver in Bitcoin, and Bitcoin is inherently nonlinear. The interquartile range, the 25th to 75th percentile, is still massive. $200 to $700 per share. That alone, that tells us under moderate volatility assumptions, this is a high risk, high reward equity. Number two, there's upside potential. In about 5% of runs, there's a 3x from today's price. The top 1% of simulations, you're looking at $1,900 per share, like I just said, but in those cases, Bitcoin approaches $200,000, and MSTR is the dominant vehicle for Bitcoin narrative leadership. We went over the downside risk already, but one of the most fascinating patterns in this simulation is what we call the bimodal regime shift. In runs where inclusion does not occur, the path is smoother, flatter, and often ends lower. But in inclusion-qualified runs, you can see an immediate 15% jump, our proxy for the passive bid, and a shift in the median trajectory upward. It's like flipping a switch, folks. The moment the S&P committee adds strategy, the stock enters a new volatility regime where flows and not fundamentals dominate the near-term price action. It's no longer just about Bitcoin's next move. It becomes about how much passive capital still needs to rotate in and how fast the short interest unwinds. That's what makes the stock so interesting, folks. You're not modeling the asset. It's the market structure around the asset that changes mid-year. It's the equivalent of owning a call option on a Bitcoin ETF that front-runs the committee, and if they approve the motion, the gamma kicks in. So let's bring this full circle. All signs point to Q2 2025 as the pivotal quarter. If Bitcoin holds above $95,000, if strategy reports positive trailing 12-month GAAP earnings, and if the S&P 500 Index Committee acts on its mandate, then by late 2025, strategy will be added to the most important index in modern finance. What follows could be $7 billion in passive inflows driven by forced allocation. That alone could produce a 30% spike in the stock price. Conservatively, before any reflexive squeeze dynamic is priced in. The headline is that Bitcoin will have entered the S&P 500. Not through derivatives, not symbolically, but directly through a company that holds more Bitcoin than any government on earth. This is the moment that Bitcoin crosses the Rubicon. It's no longer a thesis held by early adopters, venture capitalists, or crypto native funds. It's now embedded into pension funds, retirement plans, endowments, and every passive ETF tracking the S&P. Millions of investors will now hold Bitcoin exposure via MSTR, and most of them won't even know it. That's structural, and once structural, it becomes permanent. The world's passive capital base will soon hold Bitcoin by proxy, and when that happens, it doesn't just validate Michael Saylor, it permanently alters the financial topology of the entire market. So watch the earnings, watch the index committee, and when you're watching from the sidelines when this inclusion hits, remember, you weren't front-run by traders, you were front-run by history.